Hello investors, welcome to Simpli Stocks. Railway stocks had a very good rally from mid-2023 to mid-2024, but after peaking out in June or July of 2024, all railway businesses have been underperforming, and since then, no recovery has been seen in railway companies. Throughout this period, many retail investors have been holding railway companies, but side by side, we are seeing so many good new opportunities are coming up in the market. So many companies are delivering good results. In such a scenario, railway investors face two choices. Either they should rely on hope and stay in these businesses in the hope that the sector will trend again and they will recover the losses they are sitting on 20%, 30% or 40%. And the second choice is to take that capital out of the railway businesses and go into those new opportunities, those new companies that are doing better. So in today's video, we will be studying railway companies. We will look at why these businesses are not recovering and what can you expect in the future. But as a standard disclaimer, this video is not a buy or sell recommendation on these businesses in any way. You have to keep that in mind. With that, let's start. So the first business we will study is IRFC or Indian Railway Finance Corporation. You can consider IRFC as the financing arm or banker of Indian Railways. If the Railways needs to buy a wagon, coach or engine, IRFC arranges the money for it. This means IRFC works to raise money from the market for Indian Railways. And if you want to sense the direction of the entire railway sector, you don't have to do anything. You just have to look at IRFC's AUM and disbursement data to see if IRFC is giving new loans to the railways or not, or if it is raising more money from the market or not. Understand it this way. If the railway sector has to grow, the Railways Ministry will first approach IRFC and say that they are planning so and so expansion in the future. For that, we will need new coaches and wagons. So you go out and arrange the funding for them from the market. That is why, by looking at IRFC, you can gauge the general direction in which the railway sector is moving. Now, in this screenshot, you will see that there was good growth in IRFC's AUM from FY21 to FY23. AUM is the money which has been given out as loans. During this period, their disbursements, meaning new loans, grew very rapidly. This was the time when we recall the railway budget was also being increased. But you will see that the slowdown started from FY22. New loans in FY22 sharply decreased by 43% from the previous year to 59,899 crore. Disbursements decreased further in FY23, and since then, IRFC has not given any new loans. Because of this, you will see that the asset under management have not grown either. This means IRFC's business has not grown at all in the last 2 to 3 years. The old loans they had given, only they are ongoing. That is why I keep saying that IRFC is a very good example of a company whose price had gone far ahead of its growth and fundamentals. Those valuations were not supported by IRFC's fundamental at all, and still they aren't. IRFC's loan book has started growing again, but the growth rate is not that great. There is no visibility of growth in the railways loan book. Analysts repeatedly come and ask IRFC's management if there is any indication from the government to raise more funds. The management has consistently denied that there are no such directions from the government yet. In addition to this, they have slowly started diversifying into non-railways lending. They are giving loans to other PSUs and government companies. In this screenshot, you will see that they have given loans to NTPC and BRBCL, which is a joint venture of NTPC and Indian Railways. But the problem here is that these non-railway loans are only a small part of the loan book. IRFC's total loan book is currently 4,60,000 crore. This is a very large base, and their target is to give 30,000 crore in new loans this year. Even if they manage to meet their guidance on such a large base, this amounts to hardly 5-6% AUM growth. 5-6% AUM growth means IRFC has essentially become just a bank FD type of business. You will find many good banks and NBFCs where valuation is lower than IRFC and they are growing faster than this. Until these disbursements and AUM growth numbers do not go above 15% at least, IRFC is a poor business. The next business we will look at is IRCTC. You all must be aware of IRCTC's business already. They run the mobile app and website through which you can book train tickets. They also have several other businesses like the packaged drinking water business, Railneer, and besides this, they run chartered trains and are also in catering and so on. But 90% of IRCTC's profits come from their ticketing business. So the first thing that is important to understand is that sometimes when people analyze a company, they make this mistake of talking about fancy business segments. So whenever you are studying a company, you have to look at what is their main business. Even if something very good happens in the small business segments, it will not have a major impact on the overall earnings growth. Now, the issue with their main ticketing business is that IRCTC's monopoly is the problem in itself. 85% of railway tickets in India are booked through the IRCTC platform. The remaining approximately 15% share is of physical counters at railway stations. So, when IRCTC already has 85% type market share, its growth can only happen when new trains are introduced, seating capacity increases, and more passengers are able to travel. But in this screenshot, you will see that railway passengers in India are not increasing that rapidly because new trains or new seating capacity are not coming in at that speed. Ticket growth has also remained plus or minus 1%. Naturally, capacity will increase at the rate at which new trains are introduced, and that's how passengers will increase and ticket bookings will increase. But you will see that passengers only increased by 5% in FY23, 4% in FY24. This number has slightly improved in FY25, 11%, but even this is not good enough. And the 10 to 11% growth that came in FY25 has cooled down again this year. You look at IRCTC's June quarter results. In Q1, meaning in the months of April to June, their sales have increased by only 4% from the previous year. IRCTC's market cap is approximately 60,000 crore and this business is trading at a PE of 45. In such a situation, if you think about it, the growth in this business is only 4 to 5% type. The base is already so big and the valuation is also high for 5 to 10% growth. Now look, although Indian Railways is bringing more trains, but passengers cannot increase at a rate of 15 to 20% every year. At most, bookings can increase at a 10% rate, but still, 10% growth is also not a very big number. That is why at a PE of 45, I can easily say IRCTC is an overvalued business. I don't see much scope in it right now. Now, before I continue, humble request, if you're liking this video so far, do give me a thumbs up. Also, you can subscribe to our channel Simpli Stocks where we bring multiple such videos every week. Honestly, your likes and subscribes are our only motivation so that we keep bringing such high quality research to you for free. So, do like this video and subscribe to our channel as well. Let's come back to our conversation. After IRFC and IRCTC, we have two categories of railway stocks remaining. One is rail and infra EPC and the other are manufacturers. Rail and infra EPC businesses are into railway track installation, electrification, station development, constructing coach factories and so on. Whereas manufacturing companies are involved in making wagons, coaches and their parts like wheels, wheel sets, axles, brakes, etc. In rail and infra EPC, there are three main businesses, RVNL, IRCON and KNR Rail Engineering. First, let's look at these companies. You will see that the sales growth of all three of these companies was not great in FY25, meaning last year. The railway budget has not grown, nor any significant new tenders have been announced. Because of this, there has been a sudden slowdown in all of them. Besides, RVNL's guidance was never anything special. Their long-term guidance is to increase their sales by just 5% and profits by 15% CAGR. In such a situation, when this business is already trading at a PE of 58, there is no big opportunity for its shareholders here. That's why I don't understand why retail investors chase RVNL. Then IRCON's international order book has also fallen very rapidly. Its management itself is acknowledging this problem and they have not been able to fix it. Sales have also been going down in this direction. So IRCON does not have enough new orders to bring growth to the business. Next is KNR Rail Engineering. Their sales in Q1 have fallen the fastest in the rail EPC segment. You will see year-on-year sales are 38% lower than the last year. KNR has one more problem. Its management does not communicate with investors. So we won't be able to know in which direction the business is going. After this, let's look at Jupiter Wagons, Titagarh and Texmaco. These are mainly in the business of manufacturing wagons, but now these three companies are entering into different segments. For example, Jupiter Wagons is entering battery manufacturing, electric vehicle bodies and wheel sets manufacturing. Titagarh, in addition to wagons, is also in coaches. They manufacture metro coaches and they also have a joint venture with BHEL in which they are manufacturing coaches for Vande Bharat trains. Texmaco is in both wagon manufacturing and EPC. Now, the problem with these three companies has been that, and listen to me very carefully, the Indian Railway supplies the wheel sets for the wagons they manufacture. But this year, there has been a delay in supply of wheel sets from the railways. There was a shortage of them. Because of this, these companies were not able to finish wagons on time and everyone's Q1 performance was poor due to this. You will see Jupiter wagon sales were halved from the previous year. Although this wheel set shortage has normalized, but Jupiter and Texmaco also have another problem. Their future order book is also not that strong. Since new orders have not been awarded, the order book of all these three has contracted. We will also have to see whether new orders come in the future or not. Otherwise, the risk in these businesses will increase. However, the plus point in Jupiter's case is that, as I told you, they are expanding into the battery, EV and wheelset segments. In wheelsets, they have a target of 3,000 crore in sales, and in the battery and vehicle segments, the estimate is 500 to 1,000 crore each. Similarly, the growth driver for Titagarh is the joint venture with BHEL for Vande Bharat coaches. Apart from this, they have also formed a JV with Ramkrishna Forgings to manufacture wheel sets. But growth from these new businesses will be seen only after FY27 to FY28. So my concern here is also regarding the valuation of both Titagarh and Jupiter. I feel that they are overvalued at their 40 to 45 PE valuations. A lot of the future growth that is supposed to come is already reflected here. Now, you can either say that these businesses are overvalued despite such a correction, or the other perspective can be that the market has already discounted the future growth that is supposed to come from their battery wheel sets or coaches businesses, and the potential for further upside is low. In Texmaco's case, yes, one thing is surprising. Texmaco's sales also fell in Q1 this year by about 17%, but their management has still not changed their targets. The management is saying that they will achieve 35 to 40% sales growth this year, and margins will also remain stable. Now we'll have to see if Texmaco's management, which is showing so much confidence, will be able to deliver or not, because you will see their EBITDA margin also fell from 11.3% to 8.7% this year, and the market is not showing much confidence in Texmaco right now either. This business is at a PE of 26. There is also the problem of the order book here. They have only 1.4 times the orders of their last year's sales. In such a situation, if they do not get new orders, even if there is growth this year, there will be a slowdown in the business next year. So in the end, to summarize, we are seeing a clear slowdown in both railway EPC players and wagon manufacturers. Sales are falling, there are supply chain issues, and new orders are not being awarded. The growth that is supposed to come in Jupiter and Titagarh is 2-3 years away. Besides, there is no growth in IRFC and IRCTC. Their base is so large that they will not be able to grow fast, and their valuation is high based on the rate at which they are currently able to increase their sales and profits. Now, if you like this video, do give me a thumbs up. A lot of time and effort goes into making such videos. If you support us, we'll get more motivation. See you in the next video. Happy investing.